Well, fourth quarter domestic product came in much higher than expected. Is that going to hurt interest rates? Well, let's talk about it. Well, today is Thursday, the 25th of January. I hope you are doing well. We saw the gross domestic product for fourth quarter come in at 3.3%, y'all. It was expected to be at 2%, so that is much higher than expected. When I first saw that number, my first concern is how badly the bond market might react to it. But when you get into the internals of the report, the reason that we saw that really strong GDP is because inflation, the personal consumption expenditures report, the PCE component of the GDP report, actually came in much lower than expected. The GDP is calculated by taking the rate of inflation as a key part of the algorithm that determines GDP in any given quarter. And the lower the inflation rate, the higher the GDP number in relationship to it. So we actually saw a personal consumption expenditures rate of 1.5%, 2.2% was expected. That was a much lower read on core inflation than the markets were expecting, and that was the reason that we got such a high GDP number for the fourth quarter. So low inflation sounds counterintuitive, is the reason that we got a hotter than expected GDP number in the fourth quarter. That's actually been a little bit of good news for bonds. We had been seeing a pretty sharp sell-off in the bond market over the last week or so. We've seen interest rates hit fresh 6-week highs over the last 7 to 10 days, in part because of concern over a hotter than expected economy and the Fed not having sufficient reason to see cuts in this coming year. So remember, the bond market has priced in a number of cuts for 2024. Anything that suggests that the Fed may pause those cuts is going to be immediately priced into interest rates. We saw some of that. This PCE number will actually help us despite that stronger than expected GDP number. I know that's a lot to digest, but let's dive into the numbers and see where we are today. Mortgage News Daily has the daily tracking for a 30-year fixed rate conventional loan at 6.90 today. A week ago, we were at 6.89, so we're back to where we were a week ago. We had actually seen rates significantly higher midweek, but they are back down a bit from their highs of the last week to be back to where we were a week ago. We were 6.67 30 days ago, so we're a quarter of a point higher than we were the same time 1 month ago, owing in part to a hotter than expected read on the economy. So that's where we are, y'all. The market is going to be extremely data driven. And when I say the market, I'm talking about the Fed. The expectation of those cuts going into 2024 is key for us to stay on track with our projections for rates to continue to drop through this year. Data will drive that. If we get some inflationary news, then we will certainly see the likelihood of those cuts revisited by the marketplace. And you're going to see these fairly significant swings. This is going to be a period of significant volatility because the market expectation is for significant cuts, and inflationary pressures can change that expectation on a dime. So that's the reason that I am staying really focused on looking at this data daily to see where the market might be headed. We do that because we want to help the customers that we have in our pipeline to select the best possible day to lock in their rate. On any given day, the pricing that someone looks to lock in is going to vary more, frankly, than the differences between one lender and the next, right? So when borrowers are shopping between lenders, if they're not doing it on the same day, then they're not getting useful information because market movements from day to day are going to drive a greater variance than the difference between one lender or the next. The key thing is to find a lender that stays tied to market movements so that the timing of that lock can be the most advantageous for your borrower. So in any event, that's what I do. That's what we do here at BryceHomeLoans.com. It's what we do for Thrive Mortgage. It's what we've been doing for 30 years. We are delighted to have your referrals. We're always honored to receive them. Stay blessed, stay safe. We will talk to you next week, and we will see what the numbers look like then.